Nowadays, we are hearing in so many platforms, especially financial platforms, that the big corporate loans has been written off by the banks and financial institutions. We have to ascertain what is the impact of NPAs and what is NPA and how it is written off. We have to know that. That NPA means, in the case of a term loan, if the borrower does not pay installment for 3 months, it is treated as non-performing asset, NPA. In the case of cash credits, overdraft limits, if the interest is not paid for 3 months, it is treated as non-performing asset. Non-performing asset is nothing but the loan, since the borrower is unable to pay the interest and installments for 3 months, then the loan will be treated as non-performing asset. What will happen? NPA means on which it is the loan written off by the banks and financial institutions to treat separately. It is not the waiver. It is treated separately in different manner. That is called NPA. The loans or installments not paid for more than 3 months is treated as NPA by the banks and financial institutions. As stated earlier, NPA is calculated by the banks and financial institutions if the borrower does not pay the installments of term loans for more than 3 months continuously. Also, the interest on cash credits or overdraft limits unpaid for more than 3 months is treated as non-performing asset. This is the way the banks and financial institutions will compute the non-performing asset to treat separately with other running and other active assets, active borrowers. Once the loan is treated as NPA, non-performing asset, by the banks and financial institutions, they will classify the loans as standard, substandard, and loss of assets. So in the first year, the banks will write off 15% of the NPA loan account and 25% in next year, and it percentage wise, since in 3 years, the entire loan will be written off in the profit and loss account of the bank. So that affects the profitability of the banks. Means that shows negative profit or loss to the banks and financial institutions. The same value will be reduced from the assets receivable by the banks and financial institutions, since the portion is written off to classify as non-performing asset, as loss of asset. There is a lot of misunderstanding. Loan waiver is different from loan write-off. Loan waiver means totally government will take over, government will repay schemes, means social welfare schemes or farmer loans. The government will come forward to repay the loans on behalf of the farmer. Means it is the loan waived off by the banks based on the guarantee or repayment made by the governments. So that is loan waiver. Bank, it is loan repaid by the government, and that is government waived off the loans of the farmers. The same way social welfare schemes also, when the loan is small amounts, very small amounts of 10,000, 15,000, 25,000 only, to accommodate, to help the small borrowers, the governments will come forward to waive their loans by repaying the loans to the banks. So there is no loss to the banks even if the loans are waived off. So written off is different. Written off to the profit and loss account, but it will be continued to be the receivable amount in the balance sheets of the banks. The NPA loans will be transferred to stress asset management of branch of every bank. So that branch, special sector of SAM, stress asset management branch, will look after the recovery proceedings, action to be taken to recover the amounts. So it is only transfer of loan amount to different branch of a bank, that is stress asset management asset, but it is not the loan write-off, means not loan waiver. This is the difference between the loan waiver and loan write-off. Loan write-off is nothing but transfer of loans to stress asset management branch of a bank. In fact, there is no gain to the borrower, but the borrower will be treated as defaulter. He will not be eligible for any further loans by these banks and financial institutions, because that will affect their civil score to obtain further loans. So there is no gain to the borrower, by his loan becoming NPA, the borrower will be in hardship, will be in trouble for not getting any further loans from the banks and financial institutions. I stated earlier, the loan written off doesn't mean loan waiver. The borrower is not relieved. The borrower will continue to face the recovery proceedings by the stress asset management branch of a bank. So, the security offered by the borrower or the collateral guarantees offered by the banker by the borrower will not be relieved unless the loan clearance certificate issued by the banks, only after collecting all the amounts due from the borrower. So, this is not, the NPA classification will not make the borrower to relieved from his guarantors or securities offered to the bank to obtain the loans. Every NPA loan is dealt by the special branch of a bank, that is called stress asset management branch, that is dedicated to recover the loans by approaching the DRTs, Debt Recovery Tribunal, and courts of justice, maybe High Court or Supreme Court, and NCLT, National Comparator Tribunal. Proceedings before all these tribunals and courts will be looked after by stress asset management branch. That branch will look after the recovery proceedings against the borrower. Classification of NPA loans written off doesn't mean loan waiver. Means loans, the borrower is relieved from his security, relieved from repayment of loan, or relieved from guarantees. So, the loan is existing, but written off is the term used by the, according to Banking Regulation Act, to compute the real true value of assets of the banks in balance sheets. The whatever the NPA loan written off will not be shown in the balance sheet of the bank. Only the receivable and active loan assets will be shown as the assets of the banks. The non-performing assets loans will not be mentioned because it is written off in the through balance profit and loss account. It will not be disclosed in the balance sheets of banks. That NPA is out of the balance sheet of banks. Suppose we are hearing that out of the total borrowings, total loans given by the banks and financial institutions, especially in public sector banks, nearly 14 to 15% are NPAs. These 14 to 15% are taken off from the balance sheet by writing off to the profit and loss account. Means that is whatever the active loan accounts are shown in the balance sheet, and so true asset value means which loan accounts are active, means they are regular in repayment of installments, regular in repayment of interest, is treated as active assets of the banks. Means assets means loans, active recoverable loans from the borrowers, that is called true asset value of balance sheets. After taking away NPAs from the balance sheets, the true value means which is the active loan value will be disclosed in the balance sheet. There is some misunderstanding that RBI can write off the loans, or the banks can write off the loans, or financials can write off the loans, or the government can write off the loans. It is not possible. Nobody can write off any loan by the banks or financials unless it is recovered, or unless it is proved by the judiciary that it is not recoverable because of low asset value, then the amount receivable to the banks and financial institutions. So, Reserve Bank of India or concerned banks also cannot write off or waive any loans except the recovery is made, or except judiciary decided by the judiciary that recoverable amount is more than the asset value and all the assets of the borrower and guarantor has been liquidated. Sale proceeds are used to repay the loans and become the guarantors and securities. Nothing more is receivable from the borrower or the guarantor by the banks and financial. Then the judiciary direction only can relieve the borrower, and that is possible only after all the assets and guarantors' assets has been sold and used to recover the loans from the borrower by the banks and financial institutions. A Reserve Bank cannot write off any loan, cannot suggest to write off. The only guidelines the Reserve Bank can give is if the loan becomes NPA, the procedure to write off the loans means 15% for first year, 25% or 20% next year, 30% next year, 30% like that. So the procedure only the Reserve Bank can prescribe, but cannot write off any loan. Hence the government doesn't have any power. Even Reserve Bank also, even concerned bank also does not have any power to write off the loans. Present NPAs were treated as sticky advances. The sticky advances means it is loan is there, may recover after some time. And one more thing is we have to see is on these NPA loans, the interest will not be calculated. Interest will not be shown as receivable in the banks and financial institutions in profit and loss account. It will be shown on received basis. Means any interest accrued on the loan account will be credited to profit and loss account of the bank. Only it will be treated as profit of the bank only on receipt, not on credit basis. So all the interest on loans and assets realized, sale of assets only will be credited, will be shown as income of the banks at the time of receipt of sale proceeds by the banks and financial institutions. The income will not be credited. Interest was credited to the banks and financial institutions. So this is two-way loss to the banks, foregoing the interest on the such loans as well as rating of the loans. These two times means loss will hamper, will affect the profitability of banks. And that is what we have seen from last 3 years, 2017, 18, 19, 20. Nearly for 3 years, we have seen 3 years, many banks write off their NPA loans to the profit and loss account. And income also foregone. That resulted into losses or loss of profits to the banks and financial institutions. All these NPAs depends upon the recovery from the borrowers. Maybe it is a business, maybe it is a housing loan, maybe it is a corporate loan, maybe it is a personal loan, maybe it is a vehicle loan. Any loan payable to the banks and financial institution can be treated as NPA if the loan installment is not paid for 3 months and interest is not paid for 3 months. This is the only concept of computing NPA. So there is no differentiation between the corporate except agriculture. Agriculture loans are given NPA period of 2 crops, whereas in the case of all other loans, the NPA period is 90 days. If the interest is not paid or installment is not paid for 3 months or 90 days, all loans will be treated as NPA.